no brand, no company can stand still and just rely on one customer group. You have to bring in new riders, and that's what we're.
Harley-Davidson CEO Jochen Zeitz dropped a bombshell this morning. The iconic motorcycle maker will cease all production on American soil and relocate its manufacturing footprint overseas. The decision comes in the wake of newly imposed tariffs by President Trump on key trade partners, followed swiftly by retaliatory duties that have rendered cross-border commerce prohibitively expensive. For a brand so deeply intertwined with American identity, the move signals not only a dramatic pivot in operational strategy, but also a seismic shift in how U.S. manufacturers can navigate a new era of protectionism. Zeitz emphasized that the company's long-standing commitment to quality and heritage will be preserved, even as production lines move to regions offering more stable trade terms. Yet beneath the promise of uninterrupted craftsmanship lies the stark reality of a global economy increasingly defined by tit-for-tat tariff wars and the urgent need for companies to adapt or perish. Before we start, hit the like and subscribe buttons for more exclusive news. The announcement sent shockwaves through Wall Street and Main Street alike. Analysts had long speculated about the resilience of U.S. supply chains in the face of escalating trade tensions, but few imagined a flagship American manufacturer would resort to a wholesale exodus. Stock prices for Harley-Davidson surged on speculation that lower overseas production costs would bolster profit margins, only to tumble when investors considered the potential damage to brand loyalty and domestic sales. Dealers across the country scrambled to digest the news, weighing concerns about parts availability, warranty service, and the intangible value customers place on an authentically American product. Meanwhile, competitors watched closely, recognizing that if Harley-Davidson could engineer a successful offshore transition, others might follow suit, further eroding U.S. manufacturing capacity in critical sectors. For the thousands of workers whose livelihoods depend on Harley's factories in Pennsylvania and Missouri, Zeitz's pronouncement is nothing short of devastating. Skilled machinists, welders, assemblers, and logistics teams now face an uncertain future as jobs migrate abroad. Conversations in break rooms have shifted from weekend rides to frantic discussions about severance packages, retraining opportunities, and the possibility of relocation assistance. Local economies built around the rhythms of motorcycle production. Suppliers of engines, stamped steel frames, custom paint shops must confront the prospect of declining orders in shuttered facilities. Even as Zeitz pledged to work with regional authorities on transition support, the human cost of streamlined global operations is stark. Families uprooted, communities hollowed out, and the pride of long-tenured employees replaced by the hum of distant assembly lines. Behind the scenes, Harley-Davidson's intricate network of suppliers faces its own reckoning. Hundreds of small and mid-sized businesses that deliver precision parts, from brake calipers to fuel injection systems, now must reconsider their futures. Some may pivot to service the aftermarket, capitalizing on the brand's loyal base of enthusiasts who maintain older models. Others may chase contracts with foreign subsidiaries or seek new partnerships entirely. The knife-edge balance between just-in-time deliveries and tariff-influenced cost structures has vanished, forcing a scramble to establish supply hubs closer to new production sites in Southeast Asia and Eastern Europe. For suppliers unwilling or unable to follow, the repercussions could include facility closures, layoffs, and the need to entirely re-engineer their business models in a market upended by protectionist policies. Global production hubs suddenly shine in contrast to beleaguered U.S. plants. In Thailand, Poland, and Brazil, where Harley-Davidson has long maintained assembly operations, the capacity to scale up looms large. These locations benefit from favorable trade agreements, lower labor costs, and proximity to emerging markets thriving on gasoline-powered iconography. By consolidating output in these regions, Harley-Davidson aims to mitigate the financial sting of reciprocal tariffs and stabilize pricing for international customers. Yet these gains come with logistical hurdles, navigating a patchwork of regulatory environments, ensuring consistent quality standards, and maintaining the brand's storied finish work. Zeitz's plan hinges on the seamless transfer of institutional knowledge and manufacturing best practices across continents, a complex choreography requiring retraining programs, cross-border leadership exchanges, and deep investment in remote quality control teams. The symbolism of moving production abroad cannot be overstated. Harley-Davidson's motorcycles are more than vehicles. They are cultural artifacts, celebrated in films, music, and the collective imagination as emblems of freedom and rugged individualism. The company's decision thus resonates far beyond balance sheets, touching on national identity and collective memory. Political operatives wasted no time seizing the narrative. Opponents of aggressive trade policies point to Harley-Davidson as evidence that high tariffs hurt American workers, while supporters argue that firms must modernize and compete globally to survive. At the heart of the debate lies a fundamental question. Should governments shield domestic industries at the expense of higher consumer prices? Or should companies bear the burden of navigating volatile trade environments on their own? Labor unions and employee representatives have condemned the shutdown of U.S. production as a betrayal, warning that it undermines decades of negotiated labor agreements and erodes hard-won wages and benefits. Union leaders have called for emergency meetings with state governors, demanding incentives to keep operations domestic and debtor forgiveness for workers facing joblessness. Zeitz, for his part, has offered to facilitate relocation for key talent and to partner with workforce development boards on retraining initiatives in emerging high-tech sectors, including electric vehicle manufacturing and advanced composites. Still, the promise of retraining cannot immediately replace the decades of specialized expertise honed within Harley's plant walls, nor can it replicate the community bonds forged through collective bargaining and shared workplace traditions. The broader U.S. manufacturing sector watches this turn of events with trepidation. Harley-Davidson is hardly the only company grappling with the consequences of reciprocal tariffs, but it is among the most recognizable. Its move underscores the fragility of domestic production in the face of policy-driven cost pressures, prompting executives at other firms to revisit their own geographic footprints. For some, this means exploring alternative materials or reshoring certain operations. For others, it signifies accelerating relocation plans that were quietly underway. If a company as emblematic of Americana as Harley-Davidson cannot withstand trade hostilities, smaller players in textiles, electronics, and machinery may find themselves similarly compelled to seek refuge abroad, further hollowing the nation's industrial base. Small businesses that once thrived on contracts with Harley-Davidson now confront a stark choice: diversify their client list or risk obsolescence. Component manufacturers that crafted bespoke parts for limited edition runs must scout for new buyers, perhaps in adjacent industries like aerospace or medical devices, where precision machining retains high value, but trade relationships differ. Paint shops and graphic artists who supplied custom finishes face dwindling orders and razor-thin margins, prompting a shift toward consumer aftermarket customization kits sold online. Even local logistics firms and freight carriers feel the pinch, as domestic shipments give way to international container traffic routed through major ports. The ripple effect from Harley's decision underscores how the fortunes of myriad enterprises can hinge on the strategic calculus of a single large corporation navigating geopolitical headwinds. Internationally, trade partners watching the U.S. first tariffs valiantly announced and then quickly backfired in Harley-Davidson's announcement a case study in the dangers of protectionism. European and Asian governments that retaliated against U.S. goods may highlight Harley's plight as proof of the counterproductive nature of tit-for-tat duties. For countries seeking to negotiate new trade agreements, the episode offers leverage. They can demand lower barriers for other sectors in exchange for tariff relief, citing Harley as the cautionary tale that industry relocation is the ultimate price of abrupt policy shifts. Developing economies vying to attract advanced manufacturing now present themselves as stable alternatives, advertising reliable tariff regimes and free trade zones to woo not just Harley-Davidson, but any firm unsettled by Washington's trade unpredictability. Financial markets reacted in real time to Zeitz's declaration. Shares of Harley-Davidson initially climbed on the promise of leaner cost structures abroad, but then surrendered gains as analysts downgraded the stock, factoring in brand dilution and domestic revenue losses. Currency traders noted a modest weakening of the U.S. dollar against currencies of countries poised to host expanded manufacturing, reflecting recalibrated capital flows. Commodity markets responded to anticipated shifts in steel and aluminum demand, as predictive models adjusted for lower U.S. input requirements and increased overseas consumption. Corporate bond spreads for Harley widened slightly, signaling heightened investor concern about the company's ability to integrate new factory operations without sacrificing margins or market share. Consumer pricing for Harley-Davidson's motorcycles is set to change as well. Moving production to lower-cost regions could translate into smaller price tags, or at least more stable retail prices, in overseas markets battered by offsetting tariffs. But in the United States, dealers face a paradox. Without the premium tacked on for Made in America branding, MSRP adjustments may be necessary to reflect real labor and logistics costs. Whether these translate into lower price points or simply cushion dealers against margin compression remains to be seen. For American riders, the emotional calculus may become as important as the financial one. Does a motorcycle assembled in Poland or Thailand possess the same allure as one rolled off a Madison Avenue line? Retail strategies will need to address not just the cost dynamics, but the intangible value of origin. At the heart of this saga lies the enduring tension between economic nationalism and globalization. Zeitz's itinerary of factory closures and transcontinental expansions vividly illustrates how corporate strategies must adapt when national policies collide with global supply chains. The choice facing boardrooms worldwide is stark. Bear the burden of abrupt policy changes by reshoring and accepting higher domestic costs, or pursue offshore manufacturing in pursuit of frictionless trade with receptive partners. Harley-Davidson's decision suggests that, at least for some, the latter has become the only viable path in an era of escalating tariff skirmishes and retaliatory trade blocs. This moment may redefine the threshold at which companies deem domestic production untenable, a threshold now irrevocably lower than before. Investors and equity analysts are recalibrating their portfolios in response to Harley-Davidson's bold maneuver. Some hedge funds have already shorted shares of complementary U.S. automakers perceived to be similarly vulnerable to punitive tariffs. Others are scouting equity stakes in overseas parts suppliers poised for growth as Harley ramps up orders from new factories. Private equity firms see openings to acquire distressed domestic suppliers at discounted valuations, planning to integrate them into globalized operations or repurpose their assets for other industries. The interplay between corporate strategy and investor sentiment underscores a new paradigm. Companies must not only manage operational risks, but also anticipate how market perceptions of political risk can directly influence cost of capital and overall valuation. Beyond the immediate financial calculus of relocation lies the question of Harley-Davidson's identity in an increasingly digitized marketplace. While production lines hum overseas, the company must grapple with consumer expectations in a world where brand engagement occurs as much online as on asphalt highways. Zeitz has already signaled an acceleration of Harley's direct-to-consumer e-commerce initiatives, but the stakes have risen. Without the visceral draw of a hometown factory tour or the visceral pride of Made in America badges, Harley's marketing teams will need to craft digital experiences that evoke the tactile rituals of bike customization, the camaraderie of bike rallies, and the smell of oil-softened leather. Virtual reality showrooms, immersive product launch live streams, and AI-driven personalization engines may become critical tools for sustaining emotional bonds with riders who once prized the Americana of U.S. assembly lines. At the same time, Harley-Davidson must contend with the accelerating pivot toward electrification, a shift that Zeitz championed long before the tariff crisis. With production sites now relocated abroad, the company has an opportunity to integrate next-generation electric powertrains and software upgrades more fluidly, leveraging lower-cost manufacturing hubs to pilot rapid innovation cycles. Imagine modular battery designs produced in South Korea's battery belt or power electronics fine-tuned in Germany's automotive cluster, then assembled into frames in Thailand. Such a distributed R&D to manufacturing pipeline could allow Harley to outpace established players in the electric motorcycle segment by iterating models at speeds previously impossible under the rigid cadence of U.S. plants. Yet this vision demands robust cross-border collaboration, fortified intellectual property protections, and the ability to synchronize engineering standards across continents, a feat as organizationally complex as any tariff-driven supply chain overhaul. The story of Harley's overseas expansion also intersects with evolving regulations on emissions and safety. In Europe, stringent Euro 5 and Euro 6 emission norms combined with an impending shift to Euro 7 have already compelled manufacturers to innovate in low-emission technologies. By shifting production to countries bound by these standards, Harley can more nimbly conform to evolving regulations without the lag of retrofitting U.S. plants. Moreover, proximity to global safety certification bodies, TÜV in Germany, the transport certification bodies in the UK, and homologation agencies in China and India, will accelerate time to market for advanced compliance variants. This regulatory advantage not only shields Harley from the capricious effects of trade wars, but also positions the brand as a nimble global player attuned to the pressing concerns of environmental stewardship and rider safety. Meanwhile, the surge in advanced manufacturing techniques, additive manufacturing, collaborative robotics, and digital twins can be embraced more wholeheartedly in new greenfield facilities designed from the ground up. While U.S. factories often struggle to retrofit sprawling, legacy-laden plants for lean cellular production, overseas sites offer blank slates for automation pipelines. Deploying cobots side by side with human workers on assembly lines can boost throughput, reduce ergonomic injuries, and maintain artisanal finishing touches. Digital twins of each manufacturing cell can continuously optimize performance, detecting minute variations in welding precision or paint viscosity before they ripple into larger quality issues. The net effect could be a new class of Harley motorcycles that blend handcrafted allure with the consistency of Industry 4.0 processes. Investors, too, will scrutinize the implications for Harley's capital expenditures. Redirected capex toward overseas facilities may relieve the company of the steep modernization costs U.S. plants would have demanded, but it also raises questions about future depreciation schedules and the longevity of foreign assets. Stakeholders will want clarity on whether Harley will own these international plants outright or enter joint ventures with local partners. Ownership structures will influence how revenue is repatriated, how risks are shared, and how the motorcycle's global content is calculated under emerging rules of origin in new trade agreements. Each decision carries tax implications, forex exposures, and political sensitivities that could sway the company's net free cash flow for years to come. The dealer network presents another frontier of transformation. With production no longer anchored in Wisconsin or Missouri, the logistical cadence of inventory replenishment must be reimagined. Sea freight shipments, port clearance schedules, and inland distribution routes introduce new variables in lead times and costs. Dealers will need predictive analytics tools to manage inventory buffers, hedge against shipping delays, and optimize showroom allocations. Harley's dealer portal, already a hub for performance data and parts ordering, may evolve into a real-time command center integrating IoT-enabled tracking of containers, dynamic pricing algorithms responding to currency swings, and AI-powered demand forecast models that factor in local tariff differentials. This digital overhaul aims not just to preserve service levels, but to elevate dealers' ability to thrive in a remote manufacturing paradigm. From a corporate governance standpoint, Zeitz's board and executive leadership must navigate complex stakeholder dynamics. Institutional investors concerned with environmental, social, and governance (ESG) metrics will weigh the carbon footprint implications of longer shipping routes and the social impact of job relocations. Proxy advisors may press for enhanced disclosures on the landing zones of production, how much energy is sourced from renewables in new factories, whether fair labor standards are enforced, and how local communities benefit from investment. Harley's leadership will need to articulate a compelling ESG narrative, reassuring stakeholders that global growth and ethical operations can coexist. Solar panels powering parts of the assembly line in Asia, community grants for technical education in Poland, and apprenticeship programs for displaced U.S. workers transitioning to high-tech roles. Political dynamics will continue to loom large. State governors and legislators watching the exodus will debate the efficacy of targeted tax abatements, workforce training grants, and infrastructure bonds to incentivize companies to remain domestic. Yet such incentives incur budgetary costs and set precedents that may invite bidding wars among states, resources that could otherwise fund schools, roads, and public services. At the federal level, lawmakers may introduce bills tying trade relief or R&D credits to good corporate citizenship, penalizing firms that abandon domestic factories without commensurate reinvestment in local economies. Harley-Davidson could find itself entangled in policy debates that pit free market purists against economic nationalist factions, requiring deft government relations and strategic philanthropy to navigate the shifting political currents. Internationally, the redistribution of Harley-Davidson's production footprint will reshape trade patterns in unexpected ways. As factories in Vietnam or India scale up, these nations may leverage Harley's presence to attract ancillary industries, local suppliers of wiring harnesses, synthetic leather seats, or precision-cast brake pads. Governments in these countries could establish special economic zones tailored to powertrain and motorcycle manufacturing, crafting incentive packages that again test the limits of global trade rules. Such zones often cluster companies and related industries, sparking localized industrial ecosystems that benefit not only Harley, but a constellation of suppliers and service providers. Over time, these clusters can mature into export powerhouses in their own right, shifting the balance of high-value manufacturing to the global south. Cultural adaptation becomes another critical facet of Harley's new reality. As production sites proliferate in diverse cultural contexts, the company must ensure that local workforces internalize Harley's brand DNA, the commitment to quality, the reverence for craftsmanship, and the sense of community that defines the rider spirit. Cross-cultural training programs, rotational assignments for executives, and shared intranet portals showcasing best practices will be essential to avoid fragmentation. For instance, a paint technician in Thailand may need the same nuanced understanding of custom steampunk finishes that evolved in the US, just as a logistics manager in Poland must grasp the unique patterns of bike ownership among European riders. Cultivating a shared ethos across varied geographies will require thoughtful leadership development and continuous dialogue. The move also raises knotty questions about after-sales services and warranty policies. With production and spare parts depots scattered around the globe, Harley must harmonize its customer service framework to ensure consistent resolution of mechanical issues. Extended warranty programs, mobile service units, and factory-trained concierge mechanics could become hallmarks of the brand's new value proposition. Imagine a rider in Canada thousands of miles from an assembly plant, benefiting from a next-day parts shipment via expedited air freight. An operational reality that, if executed flawlessly, could even elevate perceived service levels above those offered by domestic manufacturing models encumbered by dense zoning regulations and union-mandated lead times. At the same time, intellectual property protection in certain jurisdictions will necessitate proactive legal strategies. Counterfeiting of iconic bar and shield logos or imitation of legendary engine designs has long been a concern. As Harley's global footprint expands, the risk intensifies. The legal team will need to bolster patent portfolios, register trademarks vigorously, and collaborate with local law enforcement agencies to crack down on illicit copies. Moreover, Harley must navigate differing standards for software protection in electric models, ensuring that firmware integrity is maintained when motorcycles connect to cloud platforms for diagnostics and over-the-air updates. From a macroeconomic perspective, the relocation of Harley's manufacturing represents a microcosm of structural shifts in global trade. Scholars of international economics will dissect the company's decision as an example of trade diversion, where new tariff regimes reroute supply chains toward non-tariffed hubs. In econometric models, Harley-Davidson's output shift could be measured against changes in bilateral trade flows between the U.S. and its partners, offering real-world data for debates on the elasticity of trade under protective policy frameworks. University business schools may soon add case studies of the company's strategy to their curricula, inviting students to debate whether the long-term benefits of tariff avoidance outweigh the intangible costs of severing ties to the American heartland. Meanwhile, the talent landscape for engineering and R&D will evolve. Tech workers in Silicon Valley and the Research Triangle may find new opportunities to collaborate on electric and connected vehicle projects alongside manufacturing hubs abroad. Harley-Davidson's labs could partner with overseas universities to tap into specialized skill sets, battery chemists in South Korea, mechatronics engineers in Germany, or material scientists in Brazil researching sustainable composites derived from agro-waste. Such alliances can foster a new breed of global innovation, transcending the confines of previous U.S.-centric research clusters. Yet they also require robust knowledge transfer protocols to prevent brain drain in any one region and to safeguard proprietary breakthroughs. Another dimension of this shift touches on corporate philanthropy and community engagement. Harley-Davidson's charitable foundations have historically funded veterans programs, child safety initiatives, and local arts movements in the U.S. As factories relocate, the company faces pressure to extend similar commitments to new host communities. Building vocational schools in Thailand or sponsoring environmental conservation projects in Poland will signal that Harley-Davidson values more than just profit. It invests in the social fabric wherever it manufactures. Such initiatives bolster the company's global social license to operate and can catalyze goodwill among employees, consumers, and government stakeholders. On the consumer side, social media sentiment will act as an early barometer of brand health post-relocation. Hashtags like #RealHarleySpirit and #HarleyAbroad may trend among purists decrying the loss of American production, while others may celebrate the potential for more accessible pricing and model diversity. Harley's social media team must engage proactively, crafting narratives that celebrate global unity. Riders from disparate continents sharing coast-to-coast stories, digital meetups transcending borders, and user-generated content that underscores the brand's universal appeal. Influencer partnerships in newly anchored markets can amplify positive perceptions, while community managers address concerns with transparency and responsiveness. Financially, the long-term balance sheet impact hinges on how successfully Harley leverages tax regimes in foreign jurisdictions. Some countries offer generous allowances for capital expenditures, R&D credits, or reduced corporate rates for certain high-value industries. If structured adeptly, Harley's international operations could yield an effective tax rate significantly below its previous U.S. obligations, freeing up capital for marketing, innovation, and debt reduction. Conversely, missteps in navigating transfer pricing rules or local tax audits could erode these advantages. The tax team's role in sculpting intercompany agreements and ensuring compliance will be pivotal to realizing the full economic benefits of relocation. Meanwhile, the company's credit ratings will be under scrutiny. Rating agencies will evaluate the risk profile of foreign assets, the stability of cash flows in new markets, and the resilience of Harley's core business through the transition. Downgrades could elevate borrowing costs, while stable or upgraded ratings could signal confidence in the strategy. Investor roadshows will highlight projected free cash flow growth, margin expansion from leaner manufacturing, and enhanced risk-adjusted returns, metrics that must be delivered in practice to sustain market trust. At the macro level, Harley-Davidson's shift may catalyze broader reevaluations of U.S. infrastructure policy. As companies contemplate offshore manufacturing to avoid tariffs, policymakers may pivot toward enhancing domestic competitiveness through investments in automation, workforce training, and streamlined regulatory processes. Proposals for infrastructure bills emphasizing smart manufacturing corridors, high-speed freight rail, and high-capacity ports could gain traction as a means to lower the all-in costs of U.S. production. The dialogue may shift from punitive tariffs to systemic enablers of competitiveness, reframing the debate around investment rather than protectionism. In boardrooms across industries, chiefs of strategy and operations will compare Harley's playbook with their own lessons learned. Some will conclude that agility, having the option to pivot production footprints rapidly, is the ultimate hedge against policy volatility. Others may double down on reshoring, betting that stable, long-term domestic incentives and rising wages in developing markets tilt the scales back toward U.S. manufacturing. The resulting mosaic of corporate responses will define the next chapter in global trade, with Harley-Davidson's controversial choice as a key inflection point. From a human interest perspective, global mobility programs for Harley's engineers and managers will become living experiments in cross-cultural leadership. Rotational assignments spanning 6 to 12-month tenures in new production hubs will foster global mindsets but also challenge families and personal lives. Seamless relocation services, cultural orientation workshops, and language training will be essential to attract and retain top talent. These programs may in turn shape the future of expatriate management, offering case studies in balancing corporate objectives with employee well-being. The shockwaves will also reach secondary luxury and lifestyle brands. Partnerships once centered on U.S. production, artisanal leather goods, bespoke luggage manufacturers, and premium aftermarket accessory creators must adapt. Some may follow production overseas to remain vertically integrated with Harley's factories. Others may carve out higher-end domestic niches, marketing themselves as the last bastions of American luxury craftsmanship. These micro-strategies will unfold in the smaller ecosystems that orbit Harley's monolithic operations, revealing the nuanced ways in which one corporation's strategic pivot resonates through artisanal networks. In the financial press, analysts will chart the evolution of Harley's cost of goods sold as a leading indicator for industrial supply chain resilience. Monthly reports comparing domestic versus overseas COGS, tariff savings, and logistics expenses will become staples of earnings transcripts. Investors will scrutinize operating margins in regions newly blessed by Harley's investment, using these data points to judge the merits of similar strategies in other sectors. In this way, Harley-Davidson becomes not just a motorcycle maker, but a bellwether for global manufacturing realignment. Ethical considerations will emerge as well. If new factories operate in jurisdictions with differing labor and environmental norms, activists may raise concerns about lower standards or exploitative practices. Harley-Davidson will need to implement robust auditing and transparent reporting to ensure that its global operations uphold the same principles that guided its American roots. Third-party certifications, ISO 14001 for environmental management, SA 8000 for social accountability, can provide independent validation that Harley's global footprint aligns with its professed values. If you liked this video, please give it a like and subscribe to our channel. Also, could you leave your comments below and tell us, what are your thoughts on Harley-Davidson moving production abroad? We want to hear from you. Thank you for watching, and see you next time.